For certain business models, high growth companies, businesses raising outside capital, founders building towards a sale, the C Corp offers advantages that pass through entities can't replicate. Today we're covering how C-corp taxation works when it outperforms pass-through structures and a provision called Section 1202 that can have significant implications for founders who qualify. For the first 8 episodes, everything we've covered has been a pass-through structure. Sole proprietorships, single-member LLCs, S-corps, the income flows to your personal return and you pay the tax. Today we move into a fundamentally different structure. The C corporation is a separate taxpayer. It files its own return, it pays its own taxes, and the income doesn't flow to your 1040 unless the corporation pays it to you. That creates double taxation. The corporation pays tax on its profit, and if it distributes that profit to you as a dividend, you pay tax again personally. For most small businesses, that's a bad deal. But for certain business models, high growth companies, businesses raising outside capital, founders building towards a sale, the C Corp offers advantages that pass through entities can't replicate. Today we're covering how C-corp taxation works when it outperforms pass-through structures and a provision called Section 1202 that can have significant implications for founders who qualify. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. Most small business owners are told to avoid C-corps, and in most cases, that's reasonable advice. If you're pulling all the profit out to live on, the double taxation is expensive. But the C Corp exists for a reason. Understanding how it works gives you a complete picture of the options available. A C corporation files Form 1120. It reports income, subtracts deductions, and pays a tax at a flat 21% corporate rate. The tax is paid by the corporation, not by you. If the corporation distributes after-tax profit to you as a dividend, that dividend is taxable on your personal return. For most shareholders, qualified dividends are taxed at the long-term capital gains rate. Let me put numbers to this. The corporation earns $100,000 in profit. It pays $21,000 in corporate tax, leaving $79,000. If it distributes that $79,000 as a qualified dividend and you're in the 15% bracket, you pay roughly $11,850 in personal tax. Total tax on the original $100,000, about $32,850. An effective combined rate of nearly 33%. Whether that's better or worse than a pass-through depends on your personal bracket and how much profit you actually distribute. The real strategic value of the C Corp is retained earnings. In a pass-through entity, you pay tax on the business's profit regardless of whether you take the money out of it. If the S Corp earns $500,000 and you leave $400,000 in the business, you still owe personal tax on the full amount. A C Corp works differently. The corporation pays its 21%, and whatever remains stays as retained earnings. You don't pay personal tax until it's distributed. For a business reinvesting heavily, hiring, building, funding development, the corporation is reinvesting at 79 cents on the dollar instead of whatever your after-tax personal rate would leave. If you're in a high bracket, that difference compounds over years. There's a limit. The IRS has accumulated earnings tax for corporations that retain more than they can justify for reasonable business needs. Generally over $250,000 without documented business purpose. If you're planning to raise outside capital, the C Corp is effectively the required structure. Venture capital firms need different classes of stock. S Corps are limited to one class. Institutional investors don't want K1s complicating their returns. They want a clean equity position in a C Corp. If your business plan includes institutional funding, forming as a C Corp from the start avoids the cost and complexity of converting later. Section 1202, Qualified Small Business Stock, is one of the most significant provisions for C Corp founders. If you hold stock in a qualifying C corporation for at least 5 years and the corporation meets specific requirements, gross assets under $50 million at the time of issuance, active business in a qualifying industry, you may be able to exclude up to $10 million in gain from federal income tax when you sell. That's an exclusion, not a deduction. The gain doesn't show up on your return. The qualification requirements are specific. Not every C Corp qualifies. Not every industry qualifies. State conformity varies, and this provision exists under current law. It could change. If you think you might qualify, evaluate it with a professional early, before formation, not 5 years later. C Corps can also offer certain fringe benefits to owner employees that are deductible to the corporation and not taxable to the employee. Health insurance, disability insurance, with fewer restrictions than S Corps impose on shareholder employees. The compliance costs are the highest of any structure, Board meetings, stock ledgers, corporate minutes, a separate return with its own deadline and complexity. Professional fees are higher. Here's the bottom line. The C-corp makes sense in 3 scenarios. High reinvestment, where you don't need to distribute most of the profit, raising institutional capital, or building toward a qualifying exit with the QSBS could apply. If none of those described your business, a pass-through structure is almost certainly the better fit. The C-corp isn't better or worse, it's built for a different purpose. Next week, partnerships. Here's what happens when there's more than one owner, how the IRS treats multi-member LLCs, and why the partnership agreement is the most important document in a multi-owner business. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.